Empowering farmers with intelligence. EFL AG-DATA presents to you. Hello everyone, welcome to another episode of the EFL AG-DATA Podcast, where we bring you the latest trends, opportunities, and challenges in the feed and livestock industry. And I'm Alvin. Today we are discussing on the impact of tariffs on U.S. feed ingredient exports. And joining me today is our resident market expert, Matthew Clark. Hello Matthew, welcome to the podcast.
Hi Alvin, great to be back. Thank you.
All right, we have an exciting topic today, which I believe many would want to hear and many would want to know. And well, let's start it by saying this year, U.S. President Donald Trump begins his second term in office. And with the recent news, it roused a bit of worries of another period of maybe escalating trade tensions. But I want us to start with you telling us the overview of the current state of U.S. feed ingredient exports. And maybe you can give us some snapshots of the volume and the value of key exports like corn and soybeans to major markets like China and in Southeast Asia.
Right. Thanks, Alvin. It's a good question. Now, we have to remember that the market is remembering Donald Trump's first term, right? So we look at how China is responding. There are no tariffs in place yet, but they are somewhat behaving as though there are tariffs in place. They're getting prepared. They think they know what's coming, so they're getting ready. So that factors into our discussion on China. If we look at the U.S. market overall, that's seen some shifts over the last 3 years. We've seen some changes in production. For example, beans were a big export from the U.S. in the past, and soybean meal was also exported. Now, we've seen that shift because the internal demand for oil in the U.S. is rising quite significantly to supplement the renewable diesel initiatives. Amazingly, California, over 55% of the diesel is homegrown from soybeans. So we're seeing high-priced oil in the U.S., difficult to export because of internal demand, but a lot more soybean meal coming into the overseas market. This is causing some confusion, especially as we go to China, because China is buying beans for oil primarily and soybean meal as a byproduct. So there are some tensions in the volumes being exported and imported that we see. Corn sales are continuing to be reasonably strong, I would say, out of the U.S. Not too much interruption there. Corn volumes are moving reasonably well, mainly to North Asia rather than South Asia, because there are some practical storage concerns with the slightly higher moisture grain. So I would say Argentina has the major market share in Southeast Asia. Then will be Brazil, then will be U.S. in South Asia. We look at Japan, Korea, and Philippines. These are primarily still U.S. corn outlets. So that market remains strong. The turbulence, if you like, is occurring in the China market with the beans and the soybean meal.
Yeah, but when talking about government policies and trade agreements, do you think how these policies and agreements affect the numbers?
In a way, quite substantially. The market is still digesting the first round of tariffs during the trade war in President Trump's previous term in office. So China has been preparing for that. Now, at the time when we can say that exports are normal, the U.S. had about 44% market share of China's imports. Now that would be 44% of about 105 million tons. Very significant volume of beans. Now since then, and particularly towards the last half of last year, China has been rotating its inventory of stored beans. They keep a buffer stock. That is being replaced more and more with Brazilian beans, even though the quality is lower and the price is lower. And so now we're looking forward to a point where possibly China is going to bring down the levels of imports of US beans to zero. Right now, they're looking at a market share of about 22%. But it's likely to drop further, partly because the beans are priced higher, about $450, $455 per tonne, compared to Brazil, about $430 per tonne. So there is that differential. The oil quality coming off US soybeans is better and the yield is higher. So these kind of balance out. But I sense that China is looking for establishing self-sufficiency away from the US-China trade relation volatility, which they are anticipating, but it hasn't actually come into place yet.
But looking at the situation or maybe a future situation, are there any new markets emerging that could, offset the decline in Southeast Asia?
Well, we have to look again at what kind of product is being exported, because there's less soybeans obviously coming out of the US and a lot more soybean meal. So necessarily they were looking at new markets. The US is looking to open up some of the African markets for the soybean meal. So that would be a change. I would anticipate US soybean meal being more competitive in Southeast Asia. There is an excess. And we're looking at very competitive prices FOB now from the US. But they are fluctuating a lot, I have to say.
Well, thank you, Matthew. And that goes our first episode of this exciting topic. We will do more for the future episodes, of course.
Great, thank you. And let's remember that this situation is changing weekly, if not daily.
Yeah.
So we have to stay on top of the market. Thank you, Alvin.
And to our listeners, thank you for tuning in. There goes our first episode. And the next episode, we will be talking about global competition. And if you like that, please do visit our resources section in our website and follow us in our LinkedIn and Facebook pages. Stay tuned, stay informed. Thank you.